This program is made possible by Centier Bank, serving Northern Indiana with 46 full-service banking centers that offer business, personal, mortgage, and investment services. Centier, locally owned and operated for 119 years. This program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863.
Welcome to this episode of Money Sense. I'm your host, Anthony Contrucci. The new three-legged stool in life, as it pertains to total wellness, consists of financial wellness, physical wellness, and behavioral wellness. Money Sense was created to help our viewers begin to create a plan for their own financial wellness. Studies have shown that financial stress can lead to illness, reduced productivity, and increased distraction. This series brings together experts to take a common sense approach to helping people better understand a variety of financial wellness topics. Each week, you will meet and hear from industry leaders who will explain the basic concepts you need in order to find your own sense of financial well-being. This week, we will be covering why you should budget and how to create a financial plan.
Hello, and welcome to Money Sense, a show dedicated to helping you increase your financial wellness and achieve your future goals. I'm William Lowe, Chancellor of Indiana University Northwest. As an institution of higher learning and a proud partner of Money Smart Week Indiana, IU Northwest embraces the themes of raising awareness of financial wellness and connecting consumers to accessible and affordable financial information and resources. Budgeting and financial planning, the topics of today's show, are the foundation of one's future. Understanding the importance of and applying these skills helps households to systematically plan for their futures while at the same time preparing them for the many unplanned life events. According to a survey conducted by the Council for Economic Education, in 2010, more individuals nationally filed for bankruptcy than graduated from college. As an educator and citizen, this is very troubling and signals a great need to further educate our nation, and in particular our youth, about personal finances. Free financial resources like this program and so many others offered in Northwest Indiana exist solely to help you. And it never hurts to be reminded that disaster does not discriminate. It does not make distinctions by ethnicity, age, gender, or socioeconomic status. Plan for your future. Develop a budget and build a solid financial plan so that you can position yourself and your household for your greatest level of security and success. Thank you.
Today, my guests are Alejo Torres and John Gibson. Alejo Torres is the Senior Outreach Manager for the Federal Reserve Bank of Chicago. His chief responsibility is coordination of financial education initiatives and programs, particularly Money Smart Week, held annually in about 45 states. John Gibson is the Director of Graduate and Undergraduate Programs at the School of Business and Economics at Indiana University Northwest. Additionally, he serves as the Director of the Center for Economic Education at IU Northwest. Welcome.
Thanks for having me.
Thanks for joining us today. Well, I'd like to kick it off, maybe a question for Alejo. What are the bases of putting together a financial budget?
Well, I think when you're looking at your financial picture, sometimes it could be a little daunting to get started. Mm-hmm. And so I think that the very first thing that people have to do is know that it's going to take a little bit of time. Right. But certainly the first steps in putting together your budget is obviously looking at all of the income you have coming in, right? So you look at your pay stubs, your net pay, any other side income you have, versus the expenses, right? You know, looking at your mortgage, your utility bills, looking at those fixed expenses first. Mm-hmm. And then you have to dig a little deeper. Then you have to look at some of the expenses that might be unfixed, like going out money for dining out, entertainment type of expenses, and then track those for a month. And then you have a picture of what your income is versus your expenses. And then from there, at least you have the baseline information to start setting goals to save and invest any extra money that you can.
Okay. So what you're saying is basically analyze what funds are coming in, the monies that are coming in, the monies that you know are going out, every week, every month that are fixed, and then to analyze once that's looked at, what's variable, what you as the individual or the family have control over. Correct?
Absolutely, yeah. And at that point, you can analyze and decide, okay, where can we cut and where can we redirect some funds that maybe were just being spent or slipping away to perhaps saving and investing to make more money and invest wisely.
Got it. Excellent. So I hear a lot about, obviously, budgeting, and then I hear a lot about financial planning. Are they one and the same? And maybe you could take a stab, John, at speaking to maybe the financial planning side of things?
Sure. I think the budgeting is more, day to day and month to month or week to week. Financial planning is a little more all-encompassing. Okay, so financial planning can cover everything from just your budget, paying for your fixed expenses like your mortgage or your rent and your utilities, your cable bill and things like that, all the way to managing risk through your insurance purchases, planning for retirement, setting aside money to save for like a major purchase or possibly go on a vacation. And so it's a little bit more global in scope, whereas the budget's a little more narrow in focus.
Got it. Okay. Interesting. So that being said, now that we have a better feel as to what is a budget, what's a financial plan, can maybe each of you, maybe start with Alejo, walk us through what some of those steps really look like? Maybe break it down, really, the ABCs of creating that budget for our viewers.
Yeah, well, I think, like I said, the first step is to, and you can do this a number of ways. You can go, if you have online banking, for example, that's usually the easiest way to track your expenses. And again, a month window is probably good enough for you to set that budget. And just look at all of the different expenses that are recorded on your online banking. And then you start to dividing them up, which ones are fixed, which ones are not fixed. And then again, you start to analyze that data to see, how that compares against the money you have coming in. So I think that's the number one step. I mean, there's a lot of online budgeting tools that are available for folks as well. Mint.com comes to mind. budgetsimple.com, where these are free online resources where people can use the tools that they have created on these websites to help them do that. And some of the larger financial institutions, they have some of those tools built into the online banking, but you can go to these outside sources as well. You do have to link your financial information to that website. However, that will certainly walk you through that process of budgeting to create a simple budget for week to week, month to month.
So that's interesting. So these tools then basically are there to help you kind of take all of your financial data from various sources and put it into one location so you can better manage your budgeting?
Absolutely, and a lot of people find that much simpler and easier, again, if you have that online website structure that is helping you do that, and it just tells you step by step on how to do it. But I think you don't have to use those tools. You can use a simple spreadsheet, but again, it's just going to take a little bit more of your time to investigate what your expenses are versus your income, and then making those financial decisions as to where you can cut and deciding how much you can save. I think if you're looking at it in general, experts say, it varies, but the one I like is 50% of your income should go towards your needs, your fixed, expenses, and then 30% should go to, kind of those entertainment or non-fixed expenses, and then 20% to saving or investing. So that's a general rule of thumb. Not everyone's going to be at those percentages right away.
Right.
So the important thing is to get started, so that you at least know what your financial picture is, and then set those goals so you can try to achieve that.
Absolutely. The first step is the most important step.
Right.
Yeah, I would say also, like Mint.com is really great if you're someone who is a swiper.
Okay.
Right. So if you do everything with your debit and or bank cards, it's great because it just pulls all of your spending in. It'll even pull in all of your fixed costs, your variable, everything's there.
Everything.
If you're more of a cash person, there's nothing wrong with having a journal, like a spending journal, and that's a great way to start because, or even if you are a swiper, You might want to have a spending journal because you might be really surprised at what you're spending money on. Every time you go through a Starbucks, you write it down. When you go through a drive-through, write it down. When you're at your favorite store, whether it's Target or Walmart or some department store, write down those little couple of extra things you buy when you're standing in line, and then look at them at the end of the month, and you'd be surprised how much money you might be spending on things that you felt you really didn't know. And so with budget creation, I think that's really important, is to kind of get that sense of where is my money actually going. You know, most of us look at things like, we know that we have a mortgage and we have all of these other bills that we pay. But the entertainment stuff, you know, when we're out, you go to the movies, well, do you buy something at the snack counter?
Right, popcorn, the soda, the candy for the kids potentially.
Yeah, so you might budget, you know, $50 to take the family to the movies, but without knowing it, you may spend $60, $75, and that's something that is already spent and it can't go to something else.
Well, it's interesting you say that, because I know I've kind of done that exercise myself with my family, and it's really those little things, to your point, that at the end of the month, they add up.
Yeah.
And I think sometimes we fail to realize how those little purchases or those little expenses are the ones that really kind of nip us in the bud at the end of the day. And I think, you know, another concept that I've heard of is, you know, the time value of money. And I think that same concept we're talking about those small purchases, those small expenses, really applies to the time value of money. Can you share with our viewers, you know, why the time value of money is so important, specifically as it pertains to, you know, financial planning?
Oh, absolutely. The money has a value over time. So it's kind of taking the term and flipping it around a bit. And it's basically a calculation off of interest, right? So if you, you know, it's the amount of money that you put in, you take the interest rate and the amount of time that it's going to be there, and it has really two parts. There's a future value of money. So most people think of it as like a savings account is the most simple way of looking at it. You take $100 and you put it in a savings account, and hopefully it's paying a decent amount of interest.
Right.
We won't talk about the Fed policy at this point, but you know, so a savings account,
Yes.
and say it's getting 2%, and that interest comes in every month, and we can see how that compounds over time, and that's where we get the idea of compound interest. And so if we set aside a certain amount of money and we put it in a savings account, or we put it into a 401k or other type of investment vehicle, and we can watch that grow over time, and we can predict, if we get this rate of return over time, where we're going to be at some point in the future. Another way is we can look at the present value of money when we're looking at making a purchase on, say, financing. So it's same thing, interest, amount of money, and we say we want to have $10,000 5 years from now to go towards college expenses. You know, what is that in today's money? Right? And so we really need to understand that money has a time value, right? And so if we spend it today, it's gone.
Correct.
Right? But if we save it today, even at a small interest rate, you're going to be able to consume more later, depending on what you want. So the time value of money it's kind of tricky. I can tell you as someone who teaches the stuff even at the university level, it can be a little challenging, but once you get the hang of it, and spreadsheets like Excel, you know, a lot of folks have Microsoft Office or something like that. They have tools built into it, and a lot of the online tools, without you realizing it, you're doing time value of money.
Because the formula's already there. If they
Exactly.
just kind of plug and chug.
And this is the amount of money I want
Right.
to set aside every month. This is the interest rate that the bank or the investment company is, you know, willing to give me. This is how long it's going to be there, and it just kind of automatically shows you, well, this is what you'll have. And it's a really nice tool to be able to determine, should I make this purchase on finance or should I lease? Should I, you know, buy the house now, or should I postpone a little bit? Right. Big purchases, of course, and then even things like, you know, we got to replace the refrigerator, or we got to, you know, replace the dishwasher or something. How do we go about financing that? And the time value of money can be a real useful tool.
Yeah, and how you direct that money, right? I mean, that's why the budgeting comes in handy, and it's so important because it's called, in economic terms, we call it opportunity cost, right?
Yeah. Right.
And so instead of seeing this money go by the wayside for popcorn or whatever, you could be investing that money and how it could, build more money over time. So that, that's the importance of just understanding where that money is and how you can better invest it.
And I think I would just maybe punctuate that with, I think our viewers need to realize, and something that, to your point, I think everyone struggles with, is understanding how small amounts of money over a long period of time with a disciplined approach, how with interest and compounding can, 20, 30, 40 years from now be worth so much. So not to get caught up in that present value, as you mentioned, John, where it's, it's only, I'm buying coffee and it's, it's only $5 or $6. Well, okay, it's only $5 or $6 today, but if I save that money as opposed to spending it right now, what would that be worth 20, 30, 40 years from now?
Yeah, Albert Einstein called compounding the eighth wonder of the world. Okay. And it was that if you can grasp the concept of compounding, and that cup of coffee, that value meal can turn into hundreds, thousands, maybe millions of dollars one day. If you can think on a long enough time horizon. It's very powerful.
Yeah. You mentioned, Alejo, opportunity costs. Can you guys maybe both speak to that a little bit, and how is that relevant with regards to budgeting and financial planning, and really what is it at the end of the day?
Yeah, in layman's terms, I think it's just looking at how to spend money one way versus another, right? Okay. So in the way we're talking about it, and again, instead of letting that money slip through your fingers every day, how can you put it into a savings account, which you're right, the interest rates are not so great for that right now, or a CD, or when you accumulate enough to maybe put it into the stock market, you invest that money, and again, then you're looking at that long-term picture of how that can really build some wealth over time. So I say it's just looking at that, whether it's being spent or how I'm going to invest and make it grow.
Okay.
Yeah, I think one way, there's a lot of time when you use the word cost, you think money, right, or some kind of tangible asset. But I think a good way to look at it, and for people to kind of wrap their brain around it, is think about your personal time, right? So we only have so much time in a day. And now with all of the technology that's supposed to be making our lives better, we're getting all these emails and everything's time constrained. So we only have so much time in a day. We could read, we can work, we can watch TV, but when you decide to work, that's less time you have for leisure. And so the cost of you choosing to work is less leisure. Or when you watch TV at night, the cost is not reading a good book or whatever. Okay. And so when we go and we apply it to the financial realm, just like Alejo was saying, we can spend money today, and we can, I don't know why I keep coming back to value meals and Starbucks, but I think that's how a lot of people live their daily lives. You don't even think about it, and you go through and so if you spend something today, you can't spend it tomorrow. So that's the opportunity cost. If you save today, if you say, you know what, I'm going to make my coffee at home today, right? I'm going to save that $2, $3, $4, depending on your taste, $5 or $6 on coffee. Then, tomorrow I still have that $5.
Right.
And if I invest it in a CD or in a savings account or wherever, now that $5 becomes $5.23, and that compounds to $5.48, and every day that goes by, we have more and more money that we can put towards other things to consume.
So it sounds like, financial success at the end of the day, or really success with anything, really comes down to a discipline. And I think also understanding that it's not just about the big things, right? Yeah. Saving that, the $100 or the $1,000. It's the small things too. Again, it's the $5 here. I know something we'll do with my family is, maybe we're passing a place where we can get coffee, and we're 10 minutes or 20 minutes from our house, and I say, you know what? Let's save by the time you it's you, your spouse, your kids. By the time we're done spending the money there, let's just wait and we'll get that snack at home. Now you just save $10, which to your point, opportunity cost. That can make a big impact.
And I think it's a great thing with kids when you have that type of situation to say, oh, hey, let's have a snack. Let's make this at home. Of course,
Right.
now you've got a great family activity where you're all engaged with
Great
each other.
point.
But also, the next day or the next week, and say, hey, remember when we decided not to stop to get whatever? Hey, let's go and do this. And you take that $10 or say, hey, how about picking out a new toy? We're talking little guys or whatever. And remember when the reason we're able to do this now is because we postponed
It then.
back then.
I like that.
And it really works. It helps with the little ones in particular, because I'm a big proponent of, I think you can start real young, pre-kindergarten, and teaching some of these things. And it's about repetition. I think all of us have been in a classroom and don't remember a thing. We took some course 20 years ago, and financial planning, budgeting is the same thing. If you're not keeping up with it, if you're not making it a daily habit, you're going to forget about it.
Yeah, so I mean, one thing I know I do with my children, and again, I agree with you, I think you can start at really any age, is something as simple as, for our viewers, instead of saying, hey, my son says, I want a cookie. Okay, you want a cookie? Well, you can have this cookie now, or if you wait till tonight, you can have 2 cookies. So again, it's understanding that, almost that time value of cookies, or money, where you're saying, let's put this off, and if you wait, you'll get 2 tomorrow.
Right.
With that being said, any other ideas you guys have maybe for the parents watching and joining us today for their kids, maybe some simple concepts they can apply at an earlier age?
Well, I think you hit the nail on the head, is just trying to delay that gratification, right?
Okay.
There's a lot of, that marshmallow test, I think, is, the cookie, the original
Right.
test was the marshmallow test, right? And, and in fact, there's a lot of, things that you can learn from a person, whether or not they take that first
Right.
marshmallow or they have, 2 later. But I think that's what it is, the delayed gratification, just making them understand that things cost money. I have 2 young ones at home, and it's hard for them to understand where money comes from and how you just swipe a card and
Right.
Boom, you have a new toy. So, I think those messages about, well, let's maybe ask for that for your birthday, let's ask for that for Christmas, things like that, and just trying to make them understand that you can't always have what you want all the time, And so when you're example of that and you're doing that in your daily financial life, and then showing them how you're doing
Right.
that, that they can understand
Leading.
and try to replicate that.
Leading by example.
Yeah, right, exactly.
We have a couple minutes left, and I think some of our viewers are sitting out there, and maybe they're doing pretty well. What do you have to say to that person, that family that says, hey, I think I'm already managing my finances okay, but they're not really budgeting or not really doing comprehensive financial planning? What would you say to them?
Well, I think real quickly, I would say, there's still, a great value in looking at where you're spending money because of the opportunity cost of how you can reinvest that money. So thinking of it that way, you could be making so much more money if you went through the exercise. Now, it's tough. It's not easy. You do have to stay on top of it. If you want to, look at your expenses for a month, if you want to journal things. But the important thing is just getting started, right? And
Right.
so I think that. But
And it sounds like, Alejo, to get started as soon as possible.
Absolutely.
Because with things like we're talking about today, that time value of
Right.
money, it sounds like the more time you have,
Right.
the better position you're going to be in the future for that success.
Save
So
early and often.
Start in your 20s. Start, as soon as you can.
I would also add, like, for a family who's like, you know what, we're doing really well, is sit down and take a Saturday and do a balance sheet on yourself and on your family. So
Interesting.
what assets do we have? What liabilities do we have? To get an idea of what's our true net worth. To really sit down and say, we've got this life insurance policy and we've got these investments, and take an inventory basically of what we have, and then maybe also do an income statement on yourself, right? And take a look at where the money's coming in, where the money's going out, and take a look at the goals. Say, wouldn't Europe be great if we could go on a European vacation, or go on some great vacation out west, or to start saving for that.
Absolutely.
Yeah.
No, that's great counsel. Really good advice. Well, thank you, gentlemen, so very much for your time today. That was wonderful, and I know I feel more informed, so
Great.
it's great. Thank you.
Thank you. Thanks.
And thank you for joining us today. I hope you had as much fun as we have. We look forward to seeing you next time for a new episode of Money Sense. I'm your host, Anthony Contrucci, and remember, we always try to make finance fun.
This program is made possible by Centre Bank, serving Northern Indiana with 46 full-service banking centers that offer business, personal, mortgage, and investment services. Centre, locally owned and operated for 119 years. This program is made possible by PSCA, the Plan Sponsor Council of America. For over 60 years, PSCA has served retirement plan sponsors through education, advocacy, and research. Information at psca.org or at 312-419-1863.